And believe it or not, I was asked for the very first time in my career to teach a new unit called Lending Decisions, which after we go through the discussion today, you will see that was really a very critical subject back in 2008. So your recollection may not be too clear, but it was an important event, and it still has some lingering effects going on. They're still inching down on the unemployment rate in the U.S. As a result of that crisis. But the reason I wanted to talk about it is that ethics is something that it's absolutely essential to understand and appreciate. And I think that what we sometimes overlook is the fact that if we behave unethically, it may have very devastating effects on a lot of other people. And I think that's what happened here, that there was an awful lot of suffering that was created as a result of that financial crisis. And the people who acted unethically weren't necessarily those who suffered. There were an awful lot of innocent people that had absolutely no role to play whatsoever in that crisis that were devastated by it. To begin with, we're going to see that ethical behavior is a very critical factor in financial transactions. Finance is based on trust. Without trust, a financial system just cannot operate. We can't structure legal documents to accommodate every possible thing that you don't want to have happen. Sooner or later, you just got to say, I trust you. And the more you have to rely on legal documents, and it's costly. So obviously, trust and ethical behavior is fundamental to finance. And finance is fundamental to a well-functioning economy. In finance, we have a term called moral hazard. I don't know how often it's used in other areas, but there are a lot of them. Where a moral hazard is where you have an opportunity to exploit your particular position, where you will gain, but at the expense of others. I can give you a quick example. Over the years, I've had colleagues that knew that I was a finance professor and therefore must know something about financial markets. So they asked me to manage some money for them, to invest. And the moral hazard here is that if I'm investing for myself and someone gives me money to invest on their behalf, I have a bit of a problem in segregating those two. In that what I was doing at the time was trading financial contracts. And these are very short-term kind of things. You trade over short periods of time. I could easily say that when that contract lost value, it was their account. And when it gained value, it was my account. This is true in the industry as well. You have in brokerage firms, brokers can identify if they get an order in from several people and they also think of themselves, they have to decide who gets what price. If they're buying, who got the low price. If they're selling, who got the high price. And you do this with a bit of anonymity. No one's looking over your shoulder necessarily to see what's going on. It's a very powerful temptation. And I decided the only way that Bob could deal with it was not to do it, not to have that temptation, to try to eliminate that moral hazard. But in a lot of occasions you don't have that option. It comes with the job, that you have to seriously consider the ethical aspects of this moral dilemma. Again, what the financial crisis, as we go through it, we'll see there are several moral hazards in the financial crisis. Those who have studied economics realize that economists sort of view the world in terms of a real sector and a financial sector. The real sector is what really is important, because that's the sector that talks about employment, about the production in an economy. It's the real goods and services that are being produced. The financial sector has to do with the money matters, flow of money, credit, financial instruments. And very often we find in finance there can be a crisis in the financial sector, but it's pretty much restricted to the financial sector. Stock markets go up and down and up and down. They're much more volatile than the real economy. But every now and then there can be a connection. And that's what happened in 2008. That's what made it so devastating. The financial sector is where the problem began. And what happened is eventually banks were afraid to make loans. They didn't trust anybody. Trust disappeared. You didn't know who could repay. Things were collapsing so quickly that the best strategy was to do nothing. It was a gridlock. And that spread very quickly into the real sector. And people began to lose their jobs. And their balance sheets didn't look too good either. The term negative equity is sort of a non sequitur. Obviously, equity can never be negative. Equity is what you have as your the amount of the assets that you own yourself. But they came up with the term negative equity because there were a lot of people who had homes whose market values were less than the amount of mortgage or credit that they owed. So on that asset, basically, they owed more money than the asset was worth. Anyway, let's get into the crisis. We've been in a low interest rate environment for a long time. Here it is 2016, and we're still in a very low interest rate environment. We have negative interest rates, in fact, in Japan, in Germany. In Japan, the negative rate goes all the way out to almost 8 years. In other words, what that means is that in Japan, if you buy a government security or a risk-free asset with a maturity of 8 years, you're willing to lend money for 8 years, you're going to get less money back than you pay for it. You get a negative rate of return. Again, that's just very, very unusual. And it breeds all sorts of behavior that's not necessarily healthy behavior. So it's still going on, because what it encourages is investors to take more risk. Obviously, nobody wants their wealth to go down. And if you buy risk-free assets today, you're pretty much assured it will. Even though the nominal rate in Malaysia is well above zero, the nominal rate for up to 10 years is less than the prevailing rate of inflation. So then, in other words, if you bought risk-free Malaysian securities for 10 years, your purchasing power will go down. Even though you'll get more money back than you pay, what it will buy will be lower. Now, how do you get ahead in a world like that? How can you have to take risk? You have to buy risky assets. And that can present some problems, because risk means that the price isn't necessarily going to go up. It could go down. One of the risky assets that became very popular that led up to the crisis was real estate. That was the asset of choice for taking advantage of the low interest environment. That rather than buy risk-free assets or lend money, you borrow money. And you go out and you buy real estate. And here's where some unethical behavior really blossomed, in that there was an explosion in the mortgage. Mortgage is the term for the credit that's given when you borrow on a real estate asset. There was an explosion in that market that was the result of a new sort of financial instrument that I think I've got a slide here. This is old-fashioned finance. They call them financial intermediaries. Let's call it a bank. And basically you have savers here. We're included in there if they're a household, business, government. Governments sometimes don't save very much, but when they do, a lot of that money gets channeled into a financial institution, into a bank. What is the institution? It pools that money and it makes it available to borrowers. So in the mortgage market, there was a fairly large sums of money. So essentially they're pooling money from a variety of savers, putting it together, making it available to the borrower. Now, that's the old-fashioned way. There's some moral hazard here in that you have to find out if the borrower is qualified. Will they keep their promise to repay? But you've got a lot of skin in the game, as they say. You've got a lot of money at stake. Because if they don't keep their promise, the bank is the one who's going to suffer. So again, there's a problem here in the banking industry, always has been, in that money is a pretty homogeneous thing. You don't care whether you get it from Bank A or Bank B or Bank C, you just want it. It's the same thing. And therefore, they're very competitive in this homogeneous product. And the problem is the race to the bottom. That if Bank A sets high standards, but Bank B says, hey, we can eat their lunch by lowering the standards. So they lower the standards. So Bank A goes, in other words, it's a vicious cycle that can drive the standards to a point where it's very risky to operate the business. Again, that's part of the moral hazard. Is it ethical to lend money when you strongly suspect that the party will not be able to keep their promise? I don't think that that's the way loans should be made. Another thing that makes it a moral hazard is that in many countries, I think here in Malaysia as well, they have deposit insurance on the bank. So in other words, these people over here, when they put their money in the bank, they don't have to rely on looking at how good the bank does their job and do they really qualify only those people who should borrow. We don't have to worry because there's a government agency that will guarantee this money. Well, that gives a green light to the bank then to do what they want to do. Certainly this group over here is not going to be worried about what they're doing because their risk is uncoupled from the bank. Again, that creates a dilemma. Now, the problem was that leading into the financial crisis, there was a new type of financial product that was created that basically channeled the financial markets into the process of the lending business. In that what happened was that banks, as well as other lenders, sold those mortgages rather than held onto them. That they made the loan just like they ordinarily do, but they sold them to an investment bank that would pool those mortgages together and then resell them in the financial markets as like bonds. In other words, different securities. You could go, investors could buy in the market, they could buy a security which was backed by those mortgages. What it did was it completely uncoupled the originator from the loan. In that the originator would say, okay, you're qualified, here's the money. Then they would sell that promise and it would get pooled and sliced and diced and sold in the financial markets. By that time, there was a big disconnect. So now the lenders realized, hey, all we have to do is produce as many of these as we can because there's a healthy appetite for these mortgages. We can sell them like crazy. We just have to find people who want to borrow. And that's what they did. They went after people to borrow. How did they succeed in doing it? By lowering and lowering their credit standards. There was a term that I had never heard before 2008, became very popular, subprime mortgages. I'd never heard that term before. What it meant was that the people who were borrowing these subprime mortgages would never qualify ordinarily based on standard credit criteria. That normally there is a particular limit to the loan to value relationship, that they won't lend more than 80% of the appraised value of the property. There's also a normal relationship between the mortgage payment and the income. That the income you make is going to be the basis for your paying, so the lender wants to look at that relationship. Do they have adequate income to make the payment? What did they do? They went up. Actually, there were mortgages that were granted for more than 100% of the value of the home. They were lending in some cases 110%. Come on in. Yeah. You could buy that house and get more money on top. Because the more mortgages they produced, the more the institution would make. And don't worry about how much income you have. In fact, they eventually went and pushed the limit to the point where they came up with what are called liar loans. A liar loans is an extreme case of subprime. A liar loan is where they say, when it says your income there, just put down whatever you think would be adequate, because no one is ever going to check it. None of this is verified. None of this is verified. Wow, that's a lot of unethical behavior. Very unethical behavior. But again, it was contagious. It's so easy, especially in finance. Well, everybody's doing it. Everybody's doing it. We have to do it. So anyway, I'm sort of bouncing around. I'll go back and pick up some of the missing pieces here. There was the explosion. This is mortgage-backed securities that we're talking about. The explosion because of the fact that there was an appetite for risk. That there were billboards. I can remember one, because I was teaching lending decisions and I was trying to demonstrate to the students what was going on. There was a billboard in the US, it just had a baby. And underneath it, it said, "You're qualified." That in other words, the only thing you had to do to qualify for a loan was to breathe. That's how ridiculous it became. Okay, rating agencies were involved in this too. You've heard of Moody's and Standard & Poor's and Fitch's, I think maybe some of you have. These are what we call rating agencies. What do? They judge the quality of promises. They put a grade, like we grade. They have AAA promises, AA promises. They try to give an indication to the investor the quality of the promise. Will it pay the way it was promised? Now, the rating agencies typically, in the old-fashioned way, they didn't rate individual mortgages. When you went in and borrowed money from the bank kept that promise, and they watched you. You lived in you couldn't borrow money if you didn't live in the town where the bank was. I mean, they wanted to know who you were. They were the ones who were monitoring what was going on. Now we have a complete separation. These mortgages get into big pools, and boom, some of the money, the investors in those mortgages are now not even in the United States. They're all over the world. So how do the people who invest in those securities, how do they know the quality of the promise? Well, they hire rating agencies that try to look at what went into this pool that we then sliced up and sold in the financial markets, and what is the quality of that. One of the moral hazards in that industry is that the rating agency is paid by the institution that will eventually sell the rated instrument. So in other words, if an investment bank was pooling a bunch of mortgages, and they were going to resell those in the financial market, they wanted a rating on it. And they hire a rating agency to give me a rating. Obviously, if the rating agency gives them a AAA, they could sell those for a lot more money. We want AAA ratings. Ooh, that's a moral hazard. That is a serious moral hazard. If you were running a rating agency, you need customers. Do I relax my standards in order to be able to? And the evidence is pretty clear that that's what was happening. That there were some AAA rated mortgage-backed securities that defaulted within 3 months of being rated. In other words, this AAAs are not supposed to go into default, certainly not in 3 months. So again, another moral hazard. But just think about the losses involved here. The winners are the investment banks, because once they sell those as AAAs, they're out of it. They're out of it. The people who bought them are the ones who are going to suffer if they go into default. So that was one of the problems here in terms of the rating agencies. They're not, even today, they're not that heavily regulated. This is getting into some pretty, actually it's not that complicated. The name sounds more complicated than what it is. Credit default swap. Again, that was an instrument that was created pretty much in concert with the build-up to the crisis. What is a credit default swap? It's nothing more than an insurance policy. That it says that if this particular security goes into default, if there's a broken promise, we'll make up the loss. It's like buying an insurance policy. That if the underlying asset loses value, then you can file a claim and recover the money. And that was another way that you could sell these things easier, is you could buy insurance, and therefore it would make it a more attractive product. Now the problem was that people selling insurance never really thought that they would have to pay out any claims. They thought it was like taking candy from a baby, that people buy these things, but we know there aren't that many defaults. Housing prices never go down, they always go up, blah, blah, this economy's strong, everything. They had no idea that these mortgages would start failing like crazy, and there'd be all these claims. The bottom line is that the biggest issuer didn't have anywhere near the amount of money in order to fill the claims that were being filed. That's another big moral hazard. Insurance is an area that, again, you could. I remember I was living in Tacoma, Washington, and maybe in your physics classes you saw this. In Tacoma, there's a water passage that goes around and separates Tacoma from a peninsula, and there's a bridge that connects the two, and that bridge was subject to a harmonic action from a wind, and it actually was, it was just a freakish condition. The bridge started vibrating, not because it was extraordinarily windy, but it was constructed in such a way, and the wind was blowing, it started vibrating, and then it started, the actual pavement of the bridge was flopping up and down, and the bridge collapsed. They show it in physics classes as an example of a harmonic tremor. The thing that's interesting is that when the government built the bridge, they bought insurance against an event like this. The company that sold them the insurance thought that was the dumbest thing that only governments make stupid decisions, and obviously that's a pretty stupid one. So they just pocketed the premiums. They never set up any reserves. Again, there's a disaster. When it happened, obviously the company failed. That's a moral hazard. That is a moral hazard. Okay, subpar, liar loans. Eventually what happened was that the housing prices just got unaffordable. That it was beyond reason. And it was almost like a bubble popping. And once they started coming down, then all of these types of behaviors began to combine to create a major disaster. Here's some extent of the disaster. This is a map that shows the world, and it shows basically growth rates for 2009. 2009 was probably the worst year. The crisis began in 2008, but the fallout was major in 2009. And what you see here is that anything that's in the brown category is an economy that's in recession. Again, recession is a subjective thing, that it's basically defined when an economy does not grow for at least two successive quarters. And you can see there's quite a bit of brown in that map. That the darkest is the worst. This is the U.S. here, was basically in the -2 to -4. But we even look over here. There's a little brown over here. That it affected a lot of the world. It came out of the U.S., but it didn't just limit itself to the damage in the U.S. And again, this is an indication that people were suffering. That when the economies don't grow, especially if they're shrinking, that means that people are going to be out of work. That graduate student can't find a job. No fault of your own. Here you spend all this time and hard work preparing yourself to make yourself more employable. There's nothing out there. It doesn't have to be that way. It didn't have to be that way. Okay, securitization again was one of the culprits here. That began in the 1990s, and We went through this, I think, went through this. This is kind of a cute little cartoon. You can't read it probably very well. Here we have a loan officer and is questioning an applicant, and it says, do you have any other collateral besides the email from the Nigerian prince? Not that it would matter anyway, it would probably still get. Okay, so a moral hazard, again, is whenever there's an opportunity to effectively mislead people, take advantage of your particular situation. A lot of it has to do with information. This is a closely related topic. Have you ever heard of the theory of lemons? There was a Nobel Prize awarded, believe it or not, for the person who came up with this economic theory. But it demonstrates the moral hazard. Used car people sort of got a bad reputation in the sense you don't trust used car salespeople. Why wouldn't you trust? Well, here's the theory of lemons. The theory of lemons says that there's information asymmetry. That's a big word. What does that mean? It means that somebody knows more than somebody else knows. When you buy a used car, the seller knows more about the car than the buyer. You just assume that. And now you have the trust factor. You're the buyer, I'm the seller. Do you trust me? Oh, they're a great car. Never had a problem with it. Oh, that's just spectacular. Wow, this thing will run for another 50 years, I'm sure. Only drove it a couple days a year. Okay, do you trust me? Okay, the logical response would be no. I mean, I'd like to, but I don't want to lose money on this deal. So the whole idea is that you're not willing to pay as much as you would if you truly thought that car was a good one. You're going to value it as a lemon. And therefore, if I'm a seller and that car, and I know that it's not a lemon, I'm not going to sell it. I'm not going to sell it. Why would I sell it for much less than it's worth? I know this is a good car, but you're thinking, nope. I'm just going to assume that car is not a good one. And what it means, it only lemons sell. That the only time you have a sale is when the car really is a lemon and you're paying for a lemon, and then you have a transaction. Okay, this all gets into this business of how important it is that we be able to have trust in terms of information and transaction. Okay. Here's a slide about the credit rating agencies, in that the brown line here has to do with downgrade. A downgrade, we call them fallen angels if they start off at AAA. If it goes AAA, AA, single A, we call those falling angels. They're being downgraded. And so you can see that they could claim they were doing the job very well because they didn't downgrade anything. It just stayed where it was. But here is the financial crisis. They obviously dropped the ball. That there were an enormous increase in downgrades. Okay, the credit default permitted bets to, actually you could bet on mortgage security. That was another behavior that came out of it. You could buy or sell credit default security. So in other words, if you thought that that it was ridiculous to buy credit default insurance, because these things never, look at that line, they never default. You could, in finance, you can always buy it, you could short. So what people did was short credit default swaps. That means that they thought the price was too high and it was going to come down. Or you could you could bet on it. You could say, I think that these things are cheap, and I think that there's going to be a default, so I'll buy credit default, even though you don't have the underlying security. It's like you're buying insurance on somebody's house that might burn down. That you're betting that house will burn down. Again, that sort of behavior I don't think is very healthy in a well-functioning economy. Okay, there's also blame to spread around to academics. We teach this stuff, and I think we should have been a little harder on it than what we were. But there's one thing that has been brought out in the last few years that they have identified as a culprit. Some of you may be familiar with this, many of you probably not. It's called the efficient market paradigm. Basically, it's a overwhelming belief that markets behave extraordinarily well if left alone. In other words,
non-intervention.
Yeah. Don't mess around with the market because you only make it worse. It ignores that lemon problem. It assumes that there's not information asymmetry. It assumes in effect that everybody has equal information almost. That as a result, prices always reflect value. That you can trust your price. That you don't have to do any research. If you want to buy stocks, go ahead, buy anyone, because it won't matter which one you pick, they're all properly valued. Those that aren't as good will be selling for less than those that are good. So you trust the market. And the worst thing you could do is to tamper with that relationship by putting regulations in or limit certain kinds of behavior. And that financial market efficiencies means that savings are always channeled into the most attractive and most promising investment. That's what we want capital markets to do. We want capital markets to be able to take the money that people have worked hard to earn and save and channel that money into the most productive assets that are there to lift everybody's sense of well-being, to grow the economy, to maximize welfare. Bubbles cannot occur in these markets. Bubble means that basically the price is too high. It's lost any sort of attachment to the true value, because in an efficient market there is no difference between value and price. Financial markets can regulate themselves, making regulation unnecessary. There's an election going on in the United States right now that bring out a lot of these issues. There's a group, the Republican Party is one of the political groups. They are still attached to this idea pretty much. They want to abolish regulations. Some of them want to abolish the government. The Democrats, on the other hand, are one of the candidates is really trying to go after some of those people who were most instrumental in the financial crisis. That he wants to re-regulate the financial markets. But even this is during the crisis, the head of the Federal Reserve of the United States was Alan Greenspan, and that he obviously believed in the efficient market thinking, and that he was quoted as saying authorities should not interfere with pollinating bees of Wall Street. Regulation is harmful. So let them do whatever they want to do. That he would acknowledge that there are moral hazards, but he had complete trust that Wall Street would do the right thing.
Bob, because in light of time, can we ask questions?
Yeah.
Okay.
Now, this is my conclusion. Actually, 2 more slides. This is a guy that you probably never heard of, but his buddy, his best buddy and partner, you did hear of, Warren Buffett. Have
We
you
talk
heard?
about it today.
Well, did you talk about Charlie?
No.
Okay. Charlie is Warren's right-hand man. He's been with him for ages and ages. And he has actually a better sense of humor than Warren has. And Warren has an enormous sense of humor. Anyway, remember that reputation and integrity are your most valuable assets that could be lost in a heartbeat. Again, as Jane probably has brought out, Berkshire Hathaway and Warren Buffett have set a good example of how companies can operate where finance is a dominant feature in your strategy and behave in a very ethical way. One last slide here. Unlike Alan Greenspan, Malaysia has actually been very, very benefited by the equivalent of Alan Greenspan. Zeta is the chairman of the central bank, Bank Negara, in Malaysia. And she is my canary in the coal mine for Malaysia. You've probably heard of a canary in the coal mine. It's your first sign of a problem. That they actually have canaries in coal mines, and when that canary croaks, you know you got a problem. I think that's why I always looked at her and how she was doing. Because if she went, it meant things were really bad. Really bad. Obviously, she has not succeeded in her efforts to hold people accountable for the one MDB. She tried to have the money laundering charges brought against him, but was stopped by the Attorney General. The bad thing is she's only got about 3 more weeks and she's going to retire. And I don't know who the next canary is going to be. We're helpless here. Anyway, she is the kind of leader that I think we all should try to aspire to be. She's a very highly respected woman around the world. She was considered as a finalist for a number of years ago to lead the International Monetary Fund. I mean, this is not regional, this is global. And I think a lot of it, she's a smart woman, hardworking, but she is full of integrity. And so that's why, I think it pays. It pays very well. So that's my message.
Okay, so we are supposed to leave at 5, but I want one of you to ask one question to conclude it. A very important question. Because it's, 40 minutes about this global financial crisis. What is your concern now?
Don't lead them, just have them ask a question.
Yes, okay.
See, if you cover it really well, there's no question.
Okay. One question.
Question.
Do you think the capital requirement regulations that they have will prevent this global financial crisis?
Okay, good question. I go back to my introductory remarks in the sense that I think there's always got to be an element of trust. I think regulations are absolutely necessary in the financial industry. There's just absolutely no question about it. Because the failure of the system is so devastating. Warren Buffett referred to financial derivatives as financial products of mass destruction, or weapons, financial weapons of mass destruction. I think it's not just derivatives. There are a lot of things that go on in the finance industry that can bring about massive destruction. And therefore, I think regulations are necessary. I think that standards have to be set by regulatory agencies so the playing field is more level. Like I mentioned, that one of the problems in lending is that you always have to compete, and your product is not distinguishable enough, so that whenever somebody lowers the standard, there's a powerful temptation to do it. So I think that regulatory agencies have to set standards in terms of making sure that there is not dangerous, predatory behavior within the system. But ultimately, there is no perfect regulation. That there has to be some sort of trust. And that's why I think it's so important for all of you. You're going to be in positions in your life. You may be in the banking business, and I think again it's up to individuals ultimately to make sure that the system doesn't fail us. That another person that's pretty famous in this area is a guy named Robert Shiller, who is an economist at Yale, another Nobel Prize winner. He's talked a lot about efficient markets. His idea is that the saving grace is that those people in the finance industry, or managers in general, people who are leading in the world of business and investment, want to be praiseworthy. That praiseworthiness, he feels, is a pretty common characteristic, that we want to be praised. And we know that if we're going to be praised, we have to do things that are praiseworthy. And that, he feels, is part of the insurance policy that we need, that we can't regulate everything. We have to rely sometime on just human nature. And hopefully that he's right, that will help in bringing out the best behavior in everybody. Okay, well, thank you. Enjoyed meeting with you. Have you had the accounting and finance class yet? It's not a requirement anymore, is it?
Not sure.
Is it required?